Institutional backed lenders are scrambling to raise capital, and the capital they do raise is often at rates just as expensive, if not more so, than local hard money lenders. With so much uncertainty surrounding private capital markets, we've had a number of lenders and clients reaching out to us, asking us where we think the market is headed. In this video, we'll be covering where we believe the future of hard money is headed. For those of you who don't know me, my name is Grant Smith. I'm a local real estate investor as well as a hard money lender here in Cincinnati, Ohio. We service all Ohio markets as well as Eastern Indiana and Northern Kentucky. So let's talk hard money. As of late, I've frequently been asked by clients and lenders alike where I expect the future of hard money loan rates and capital supply to be. Truth is, it's highly uncertain, but there are certain factors that we're keen close on to see where we believe the market's going to end up. The key components that drive rates differ largely based upon how the lender raises the capital that they use to deploy into their deals. Regardless, we monitor 5 key factors when trying to keep a pulse on the market, and they are the federal funds rate, note investor risk tolerance, alternative investment opportunities, supply and demand of real estate, and supply and demand of capital. So let's talk the federal funds rate. It's no secret that the Fed has been raising rates in order to try and curb inflation and slow down the economy. It would be an understatement to say that the Federal Reserve didn't drastically change the landscape for lenders over the last 12 months. For those who don't know what the federal funds rate is, I like to quote these 2 definitions by Investopedia. First, the formal definition, which is, the federal funds rate refers to the interest rate that banks charge other institutions for lending excess cash to them for the reserve balances on an overnight basis. A more practical definition they have, which I prefer, is an interest rate set by the Federal Reserve to indirectly manage interest rates, inflation, and unemployment. Now, the inflation we've seen from 2021 to 2022 is unlike anything we've seen since the Great Stagflation in the 1970s. This has led the Federal Reserve to raise interest rates 8 times since February of 2022, with 2 more scheduled rate hikes to take place here in 2023. So why is the federal funds rate such a big deal to hard money lenders? On a macroeconomic level, it affects the 4 other factors that we're about to discuss, which are note investor risk tolerance, alternative investment opportunities, supply and demand of real estate, and supply and demand of capital. In addition, some lenders have chosen to source institutional capital as their primary capital source. While this previously allowed institutional lenders to offer rates lower than private capital lenders, that has now changed. Those institutional lenders are now more expensive or have halted lending altogether. The next point we want to discuss is note investor risk tolerance. Being a private lender, note investors are the bedrock of our capital base. Their risk tolerance ultimately determines the rates at which we are able to offer to our customers. As of right now, an 8 to 10% annual percentage rate of return has been the standard for raising capital from note investors for hard money loans. However, some markets are proving more volatile and thus risky. The greater risk has turned off a number of note investors and has put them in a pattern of a wait and see type of approach, which is very similar to the behavior we've seen from residential home buyers through the second half of 2022. Now, there are 2 ways that private lending shops can mitigate their capital raise issues. They can offer higher rates of return to capital investors, which ultimately drives up the price that they're going to have to offer to the end real estate investor, or lending shops can up their criteria by requesting larger down payments, lower LTVs, or better borrower quality. The next subject worth noting is alternative investment opportunities available to capital investors. As a whole, it's worth mentioning that hard money loans are just one investment product among many available to investors. The most notable investment product on the market is the 1-year Treasury bill because it is noted as the risk-free rate of return. At the beginning of 2022, a 1-year Treasury bill was paying 0.31% interest per year. At that time, a private note collateralized by real estate paying 8% was highly competitive because it had a risk premium of 7.69%. As we sit here at the beginning of 2023, that same 1-year Treasury bill is now paying 5%. Meanwhile, private lending shops are raising capital from private investors at 8 to 10%. That means the risk premium is now only 3 to 5% for the same exact collateralized loan. The question now becomes, how much higher will 1-year Treasury bill rates go before it is no longer worth the risk premium to private note investors? Similarly, how will hard money lenders sourcing private capital react? The next factor we are closely monitoring is the supply and demand of real estate. The supply and demand of real estate is something that will vary market by market, asset type by asset type. But in general, we're seeing more single-family residential housing come onto the market across the board in the United States. This will undoubtedly slow home price appreciation and even lead to depreciation in some markets. This will push away speculators and home builders alike. While there's certainly more qualified authors to speculate on the housing prices nationally as a whole, I'll go ahead and take a stab at where I predict asset prices for single-family residential home prices to end up for major Ohio markets like Cincinnati, Dayton, Columbus, Akron, and Cleveland. The Rust Belt of the United States tends to be far less volatile in home prices. Thus, I foresee more homes to come onto the market here in the major Ohio markets, with little to no appreciation occurring in 2023. I'm anticipating that residential home buyers will continue to accept the new interest rates that are being proposed to them, and real estate investors will slowly have to come to terms with the investment prospectus and overall asset prices of the assets that they're trying to sell. The last point I want to note is the supply and demand of capital. One of the greatest threats to hard money lenders with a private capital base is the influx of business they're receiving from the institutional lenders who can no longer support that business. With many institutional lenders pausing or closing their funding altogether, it's left a number of great real estate investors scrambling to find funds for their deals. For example, in 2022, we were closing roughly 1 in every 24 loans, while at the start of 2023, we're now closing about 1 in every 10 loans. But it's not just borrower quality that's up. It's leads, and it's deal quality too. With these 5 factors in mind, I'd like to conclude with where I see the future of hard money lending headed. With the additional federal funds rate hikes, I anticipate that institutional capital lenders will become more and more expensive than the local hard money lenders that they're competing against. And while some lenders may argue that the interest rate environment that we're currently in is unusual, these rates are not all that atypical. This means that the rate at which private capital is lent will largely be determined by the risk tolerance of note investors, the number of real estate transactions that are taking place, and the demand for that private capital. We stay bullish on the opportunities for both real estate investors and note investors to profit significantly in this shifting market. And we do look forward to adjusted asset prices that do take into consideration the new rates required to acquire them. Until then, get creative with your financing options like subject to, hard money loans, or raising your own private capital to fund your deals. If you have the deal, the capital will follow. If you like this video, please give it a thumbs up and subscribe for more content. Thanks, guys.